Yeah, so you've talked about risk and return, and I'll bring this to Charles. Moses has mentioned, and from the sentiments I'm getting from Moses, most of the time our clients invest emotionally and not strategically. Can you just bring the aspect of goal-based investing and how does the risk and return come into play? For example, if I'm a client and I'm saving for educational fund for my child,
yes,
should I put that money in equity fund because generating 42%, for example, last year?
Yeah,
that's a question that a client could ask.
Yeah. And I appreciate that question because sometimes we find that our goals and how we invest is mismatched. The emotional aspect is we're chasing returns. The higher, the better. But if you're not looking at all-rounded aspect of what do you want to achieve or what objective are you trying to seek, then you might find yourself chasing a return that will not satisfy the objective that you required. So let's use that example of a parent who wants to educate their child through primary school, secondary school, and university, and they want to start investing from square one. So which fund can they consider? So for us, Nabo Capital, we do, our main pillar is goal-based investing. And what that means is we're not only looking at subscribing you to a fund or subscribing you to certain investments, be it bonds, equities, etc. But we're saying, okay, your goal is educating your child. How long do you want to educate them for? Say, for example, you want to do that for the next 15 years. And how much do you anticipate you require to pay school fees over those 15-year periods? So we're able to take you through that journey, and it's what Moses and his team does quite well. And they're able to determine, okay, for you, for example, to fund these specific fees, you'll need a certain amount of money to start with. And then you can be doing monthly top-ups, for example. And so now the question sits now with, for example, Nabo Capital and saying, okay, for this client, this type of client, you need a low to moderate risk. Why low to moderate? You can't go on the high risk side because, as we've said, and I think the common theme is no free lunch. No free lunch. I think that can be a key takeaway today.
Yeah, true.
If everyone forgets everything, no free lunch. And so if you're taking high risk, there's potential that your money could lose. The equity fund, equities are doing well the last 2 years, but the last 3-4 years before 2024, they were negative. So that means you are eroding your capital. So you're reducing the amount of money you're looking now to, for example, if you're putting money in the fees. So if it's an education, we'll go low to moderate. And what that means is you'll need, let's say, a fixed income fund, which fits in the moderate side, where you're getting a higher return than a money market fund. And then a portion of that can be allocated, say, to a money market fund. A money market now is for the liquidity, because this is an education fund that you will need to grow, but also over time you'll need to redeem or withdraw to pay the respective term fees for your child. So it's always good, especially if you feel that you do not have that knowledge to understand these aspects as an investor. That's why fund managers like ourselves exist, to provide the ease of you understanding, shaping your goal. So you might have a goal in mind, but we help you clarify that even further. And then we now align that to the investments to make sure you're able to achieve your goal within a certain period of time. And so we do highly recommend that goal-based investing is a way to look at it, but because at the end of the day, people invest with a particular goal. You're investing for a happy retirement. You're investing to buy a home. You're investing to buy a car. You're investing to have a holiday trip. You're investing for your education, for your child's education, etc. And so I think it's a good way to now look at it. Yes.
Okay. Yeah. Thank you, Charles. That was well outlined. You've just mentioned something slightly on as you are trying to describe, to just expound on that risk and goal-based investing. Something on retirement. And also just want to bring to our viewers that Nabo Capital, we do have retirement products. We currently have registered with Retirement Benefits Authority to offer umbrella schemes, Nabo umbrella schemes. We also have individual pension product and also IDD. So if you want us to invest for you, be sure that we do have those lenses and expertise, as Charles has slightly mentioned in his explanation. I'll quickly come back again to you, Charles. This is a question that probably Moses will be receiving quite often when he's interacting with the client.
Yes.
A client could go to Moses and tell Moses, I have 100 million and I want you to invest this money for me in the next 5 years. Where will you put this money? Where will you allocate this money? And I don't want to struggle. For me, I just want return. Can I double this money first? So I think just maybe outline in the easiest way that a client maybe wants to invest either 10 million, but let's use 100 million.
That's the toughest question so far. I'm sweating already. But I think the first point, even as Moses maybe will elaborate later, is it's understanding the if it's a client, let's say high net worth client with 100 million Kenya shillings willing to invest, it's understanding the client's requirements. Basically understanding, okay, what type of return are they looking at? What's their risk level? Could be low, moderate, high. What's their liquidity profile? Do they want this money as soon as a year, as soon as 6 months, as far as 5 years, as far as 10 years? So that liquidity makes sense. That you have to also understand the tenor, as I've mentioned, and other considerations that come through, because others may be of the view, let's say, I only want to invest in Kenya alone. I want to keep my money in Kenya. Others may be, I want to invest offshore. I already have enough in Kenya. I want to invest abroad. And so all these considerations have to take place before giving a vanilla. We call it vanilla. So it's not a plain, all of you put in equities. Fred put in equities. Moses put in bonds. But it's understanding now that profile of that customer. And so once you've gotten an understanding of the profile of the customer, now you're able to break it down. Where we foresee that there is good opportunity, especially over the next 5 years or so. We do think that there are emerging opportunities, especially in the alternative space. I think even Moses has touched on this briefly. For example, the IREIT market. The IREIT market is interesting because what Kenyans understand a lot is land. Shamba. We understand that more than ever. It's the plot. Everyone, if your first investment for most people listening to this is probably, unless if you're millennial and above, is your first investment probably was land, shamba, mahali. But now there's a way in which now, for example, IREITs, which are now becoming more prevalent in the capital markets, they're investable in the stock market. It's an ownership in a property. Now instead of owning a land that might not be producing any income, you might just have, most people have bare land. They haven't put in structures, they haven't put any farm where they can earn any money. So it's just a land hoping for appreciation. And that appreciation can take a long time. Some appreciate quite fast, others not. So it's a bet, almost a gamble. But now REITs, for example, or IREIT specifically, is you're investing in an asset that is already generating funds. And so you're investing and earning a portion of that income. It could be a building, right? And so that building has tenants, they're paying rents, and the rents increase through each year. They increase or they escalate due to inflation. So you're getting a portion of that. So, and also they are more liquid. Land, for example, if you own land, and many clients can testify, if they are looking to sell that land, can take 6 months to 2 years. And it can be also hefty costs, let's say, lawyer costs, conveyance costs, etc. And so I think that is another way in terms of looking at alternatives. So alternative investment is picking up, not just on the I rate, but also infrastructure. We've seen the government come up with different infrastructure investments. For example, the Talanta bond, maybe many weren't familiar, that the government actually came out with a bond to raise funds to build the Talanta Stadium, which is expected to be a world-class stadium to host the AFCON. So that was also fundraised through at I believe a 15% level, if I'm not wrong. And so we are seeing this type of opportunities. Apart from that, also we're seeing the equities market rebound. It's been a tough couple of years for it, but now it's improving. And we are seeing those companies their earnings are quite strong. There's a lot of digital infrastructure enabling this. For example, I mentioned earlier the ZD Trader, which now allows the masses to invest quite easily. And anyone can invest with as little as 10 shillings, 100 shillings, etc. We also do think a key part of allocation is understanding diversification. Diversification in terms of currency, right? So you can diversify in currency, you can diversify in asset class, but also you can diversify in geography. We think where we are in this state of the world, and that there's need for diversifying beyond your own country. So allocating to other different countries, if you can allocate to dollar, having something, a recommendation on dollar, because the currency right now in Kenya is quite stable. But the last 2 years before 2024, the currency was in a free fall. And any type of volatility could come. So you're better off also being protected. So even though things are good now, you need to look beyond just now. You need to look 5 years, 10 years time. So we think with looking at, to summarize our point, looking at alternative assets, looking at the equities market, and also looking at diversification through offshore dollar-based products could be a good way for that type of allocation, especially for maybe someone within that moderate to high risk looking to invest, say, the 100 million shillings.